All right, what we're going to do right now is work some practice exercises from Chapter 8 of the textbook. We're going to work practice exercise 8-1A, practice exercise 8-2A, and practice exercise 8-5B. All of these have examples in the textbook, so if you wanted to follow along and learn it, you could refer to example exercise 1 on page 364, and it would sort of walk you through a problem that's just like this. Exercise 2 on 367, it would have a problem like this, and exercise 5 on 375 would have a similar problem. And of course you can refer to these exact problems in the back of the chapter. So these are the problems we work in class, and I'm going to work them again for you right now. The point of Chapter 8 is to understand how to write off bad debt. And you never know exactly when this is going to come up, but when you do know, say somebody declares bankruptcy who owes you money, or they just say, I don't have the money, man, I can't pay, so you need to write them off your books. You can't keep that asset on the books because it's not an asset, and you recognize the expense. So there's two ways of doing it. There's the direct write-off method, which is typically used by smaller businesses, and there's the allowance method, which is typically used by bigger businesses that have a lot of receivables. They know some will go bad, they just don't know which, so they set up an allowance up front and draw against that for the expense. The first problem we're going to work, practice exercise 8-1A, is the direct write-off method. So in this example, we're going to just directly write off an account receivable as soon as we find out about it. The problem says, journalize the following transactions using the direct write-off method. So this is something you need to look for when you're taking exams. Does this exam ask for direct write-off, or does this exam ask for allowance? All right, so this says direct write-off method for two receivables. On February 12th, we received $800 from Leo Jorgensen and wrote off the remainder, $2,400, as uncollectible. So a guy came in and says, this is all I got. Here's $800. Sorry, I can't pay the rest. So we know we have to write it off. And then the other reinstated the account and received $2,400. So yay, he came back a few months later and paid it. So we're going to write it off using the direct write-off method, and then we're going to reinstate it. So it says do the journal entries. So that we know how to do, right? We know journal entries are going to have the date, and we need accounts, and we're going to have a debit and a credit, or maybe more than one of each, who knows. Let's see. All right. So the date is February 12th for the first transaction. The accounts, that's what we need to figure out. So when you're using direct write-off method, you're writing off the asset, account receivable, Jorgensen, right? And you're recognizing the expense, bad debt expense. So those are the two accounts. Anytime you're journalizing a transaction of any kind, your first step is to analyze the transaction. You figure out what accounts are affected, what amounts, and then you know whether it's increasing or decreasing those accounts, and that tells you, oh, this should be a debit, this should be a credit. So in this case, we're getting $800 in cash, so that's an increase in cash. Leo Jorgensen had an account receivable for apparently $3,200, right? Because $2,400 is what we're writing off, and he gave us $800, so $800 plus $2,400 is $3,200. We also know that there's going to be a bad debt expense because some of this we're not going to get, the $2,400. So that's going to be a bad debt expense. So let's go ahead and increase cash $800, increase bad debt expense $2,400, and decrease accounts receivable $3,200. All right, so cash is always easy. I always start with cash. So I can always figure out if I'm getting cash in or if it's going out. Of course, in this case, cash is coming in, $800. Anytime cash comes in, that's a debit. And we know we got to have this $2,400 expense. So when expenses are put on the books, that's always a debit, right? So bad debt expense. So we added this expense, so that means it's a debit. And we're going to decrease this collectible from Jorgensen. So that's always going to be a credit, right? Because accounts receivable are assets. They decrease with credits. Account receivable, always important to write down who it's coming from, right? Because you track individual accounts receivable in these subledger accounts. You don't just put them all in one big account, because then you can't track who's paid and who hasn't. So accounts receivable Jorgensen is getting reduced $3,200. All right, and we're done. That's all there is to it. We got our $800 cash in, we increased our bad debt expense, and we wrote off that receivable, and our debits equal our credits. That's a great journal entry. The next thing that happens, on May 3rd, he comes up with the money. That's great. We're going to post that. So we know that we wrote off that $2,400. That account receivable no longer exists. Here it is. It got written off. So we need to put it back on the books. Reinstate that receivable. So in order to do that, we're just going to flip this transaction, right? Because then we no longer have the expense, because he actually paid us. So that bad debt expense goes away. The account receivable needs to go back on the book. So it's just the reverse of this, right? We're going to debit, except for this amount is going to be $2,400. We're going to debit accounts receivable and credit bad debt expense on 5/3. All right. So account receivable Jorgensen, $2,400. Bad debt expense, $2,400. And remember, your debits are out here on the edge, the left edge of your journal, and your credits always get indented a little. It's easier for an accountant to read it. They go, oh, that's a credit, it's indented. So always do this. All right, so now we've got the account back on the book. We need to now post that cash. So that's just cash to an accounts receivable. We already know how to do that from way back in chapter 2. Cash, $2,400, increase to our cash. Account receivable, Jorgensen, $2,400. All right, so that's great. So that's example exercise 8-1A. All right, and I'll scan and put that on the books. All right, so the next thing we're going to do is 8-2A. Sort of a similar thing, but this company uses the allowance method. And as you'll recall, that means they have set up an allowance in advance. So they've already written off the expense. They just didn't know which accounts would go bad. So what happens next is they write it off to the allowance. All right, so the same idea, it's just using the allowance method. PE 8-2A. All right, so it's the exact same thing. On February 12th, we got 800. We wrote off 2,400. Reinstated 2,400, but this time allowance method. So like the previous one, we have to analyze the transaction. So what happened? $800 cash. So that's an increase in cash, right? Wrote off the remainder of the account receivable. So there's the account receivable. We know we got to do that. But instead of bad debt expense, we write it off to allowance for doubtful accounts. All right, so it's going to look pretty similar to the one we just did, but instead of bad debt expense, it's allowance for doubtful accounts. Okay, so the date, accounts, debit, and credit. All right, so on February 12th, we got our cash, right, of 800. And we had our allowance for doubtful accounts, right? 2,400. And then of course the account receivable from Jorgensen, 3,200. So it looks just like the one we just did. This is the only difference. Because it's the allowance method, we use the allowance for doubtful accounts instead of bad debt expense. All right, so then what happens? We reinstated the account and got our $2,400. All right, so that was May 3, right? So we have to put it back on the book, so we flip that transaction. Account receivable, Jorgensen, 2,400, and allow for doubtful accounts, 2,400. And now we have to go ahead and consider that cash that they brought us in. So we're going to put, now that this is back on, now that this is reinstated, we post the cash. Cash, 2,400. Jorgensen, 2,400. All right, there we go. That's awesome. We did that. I'll stop here, and the next video will continue with practice exercise 8-5B.